What you're about to hear is going to sound impossible. But I need you to stay with me because the evidence is overwhelming and the implications are staggering. Right now, as I'm recording this, something extraordinary is happening in the gold market. And I don't mean another routine price increase. I'm talking about a fundamental restructuring of the global financial system that's been quietly unfolding for years, and it's finally reaching a critical inflection point. Let me start with a number that should make your jaw drop. Central banks purchased over 1,000 tons of gold annually from 2022 through 2024. That's more than double what they were buying just a few years earlier. We're talking about the world's most powerful financial institutions, the people who literally control the printing presses, abandoning their own currencies to buy gold at a pace we haven't seen in modern history. But here's where it gets really interesting. These aren't just any central banks. We're seeing unprecedented buying from China, Russia, India, Turkey, and a coalition of nations that represent more than half the world's population. They're not buying gold because they think it's a good investment. They're buying it because they're preparing for something. Now, you've probably heard the term Great Reset thrown around. Maybe you've dismissed it as conspiracy theory. Maybe you've wondered if there's any truth to it. Let me show you what's actually happening, and you can decide for yourself. The World Economic Forum has been openly discussing a reset of the global financial system for years. They talk about it in white papers, at conferences, in policy recommendations. But what they don't talk about, at least not publicly, is the role gold is playing in this transition. And that's where things get fascinating. Think about what money actually is. For most of human history, money was something tangible: gold, silver, commodities that had intrinsic value. Then in 1971, something unprecedented happened. President Nixon severed the last link between the dollar and gold. For the first time in history, the world's reserve currency was backed by nothing but faith in the U.S. government. That decision unleashed an era of unlimited money printing. And for 50 years, it worked. The dollar remained dominant. America could run massive deficits without consequence. But every system has limits, and we're now seeing those limits tested in real time. Let me paint you a picture of what's happening behind the scenes. In 2022, something shifted. Russia was hit with unprecedented sanctions after the Ukraine conflict. Overnight, hundreds of billions of dollars in Russian foreign reserves were frozen. Assets that Russia thought were safe, that they believed were their sovereign property, were suddenly inaccessible. Now, put yourself in the position of a central banker in China, or India, or Saudi Arabia. You're watching this unfold, and you're thinking, if they can do that to Russia, they can do it to us. Your trillions in dollar reserves, your treasury bonds, your supposed safe haven assets, they're not really yours. They're permission-based. They exist at the pleasure of the U.S. government. So what do? You start looking for alternatives. And there's only one asset that's truly sovereign, that can't be frozen or sanctioned, that has maintained value for 5,000 years: gold. This is where the data becomes absolutely compelling. China's official gold reserves have increased steadily, but here's the thing: nobody believes their official numbers. Industry experts estimate China's actual gold holdings could be 3 to 5 times higher than what they report. They're buying through back channels, through state-owned enterprises, through Hong Kong. They're accumulating gold in secret because they don't want to trigger a rush before they're ready. Russia has been even more aggressive. They've essentially de-dollarized their economy. They're settling trade in rubles, yuan, and gold. They've built a payment system that bypasses SWIFT. They're creating the infrastructure for a post-dollar world. And it's not just adversaries. Look at Poland. They repatriated 100 tons of gold from the Bank of England. They're bringing their gold home. Singapore has become a major gold trading hub. The UAE is stockpiling gold. Even traditional U.S. allies are hedging their bets. Now, here's where this connects to you, to your wealth, to your retirement. Because what we're witnessing isn't just a geopolitical chess game, it's a fundamental repricing of gold relative to fiat currencies. Let me explain what I mean. For decades, gold was suppressed, not through conspiracy but through market structure. The paper gold market, futures contracts, ETFs, unallocated accounts, created the illusion of abundant supply. You could trade 100 ounces of paper gold for every ounce of physical metal that actually existed. This kept prices artificially low. But something's breaking. The premium for physical gold over paper gold is widening. Delivery delays are increasing. The COMEX, the major futures exchange, is seeing unprecedented delivery requests. People don't want paper promises anymore. They want the actual metal. And this is creating a squeeze. Because here's the dirty secret. There isn't enough physical gold to satisfy demand if everyone who owns paper gold decides they want delivery. The system was built on the assumption that most people would just trade paper back and forth. But that assumption is being tested. Look at what happened in March 2020. When COVID hit and markets crashed, gold briefly traded at a $70 premium in New York compared to London. Why? Because physical gold couldn't be transported due to flight cancellations. The paper market said one thing, but physical reality said another. That was a warning shot. Now we're seeing similar dynamics, but for different reasons. It's not about transportation anymore, it's about trust. It's about the growing realization that paper claims on gold aren't the same as holding the actual metal. Let me give you some context on where prices are headed. Gold recently surged past $4,000 per ounce. That's not a typo, $4,000. And analysts are saying this isn't the top. Some are projecting $5,000, $7,000, even $10,000 or higher in the coming years. Why such extreme targets? Because they're not just looking at supply and demand, they're looking at monetary debasement. They're looking at the ratio of gold to the money supply. And by that measure, gold is still historically cheap. Here's a thought experiment. In 1980, gold hit $850 per ounce. Adjusted for inflation, that's over $3,000 in today's dollars. But here's the thing. The money supply has exploded since 1980. We've printed more dollars in the last 15 years than in the entire previous history of the United States. If you adjust gold for money supply growth, not just inflation, the equivalent of that 1980 peak would be somewhere between $15,000 and $20,000 per ounce. Now, I'm not saying we're definitely going there, but I am saying the math supports it. And more importantly, the behavior of central banks suggests they believe something similar. Think about the incentives here. If you're a central bank holding dollars, and you see the U.S. running trillion-dollar deficits with no end in sight, what do? You can't sell your dollars too quickly or you'll crash your own reserves. But you can gradually shift into gold. And that's exactly what's happening. This creates a self-reinforcing cycle. As more central banks buy gold, the price rises. As the price rises, it validates the decision to buy gold. As gold rises relative to currencies, it exposes the weakness of those currencies. And that drives more buying. We're potentially at the beginning of a multi-year, possibly multi-decade bull market in gold. Not because of speculation, but because of fundamental shifts in how the world thinks about money and reserves. Now, let me address something important. If you're sitting on significant retirement savings, let's say $100,000 or more in IRAs or 401ks, you need to understand how this affects you. Because most retirement accounts are heavily weighted toward stocks and bonds, assets that are denominated in dollars, assets that lose value as the dollar loses purchasing power. There's a strategy that a lot of people don't know about called a gold IRA. Basically, it allows you to hold physical gold inside your retirement account without triggering taxes or penalties. I put together a free guide that explains exactly how this works. It's in the description below. It covers the mechanics, the rules, the pros and cons. If you're concerned about dollar devaluation and want to explore alternatives, it's worth checking out. All right, back to the bigger picture, because there's another layer to this story that's absolutely critical. The BRICS nations, Brazil, Russia, India, China, South Africa, have been working on alternatives to the dollar for years. They've talked about a BRICS currency. They've discussed gold-backed trade settlements. And while the details are murky, the direction is clear. They want to reduce dollar dependence. Now, imagine a scenario where BRICS nations announce a new trade settlement system partially backed by gold. Not a full gold standard, but something hybrid. A system where trade imbalances are settled in gold rather than dollars. What happens to gold demand? It explodes. What happens to dollar demand? It drops. This isn't science fiction. Russia and China are already settling some trade in gold. Iran is selling oil for gold. These are real transactions happening right now. They're small scale, but they're proof of concept. And here's the kicker. The U.S. can't stop this. We can sanction countries. We can freeze assets. But we can't prevent sovereign nations from trading gold amongst themselves. Gold is the ultimate neutral asset. It doesn't care about politics or sanctions. It just is. This is why some analysts are calling this the Great Gold Reset. Not because of some shadowy conspiracy, but because the natural evolution of the global financial system is pushing us back toward gold as a settlement asset. Not for everyday transactions, that's impractical, but for large-scale international trade and reserve holdings. Let me give you another historical parallel. In the 1960s, France under Charles de Gaulle started demanding gold for their dollar reserves. They saw the U.S. was printing too many dollars relative to gold holdings. They called America's bluff, and they were right. By 1971, the U.S. had to close the gold window because we didn't have enough gold to meet redemption demands. We're seeing echoes of that today. Countries are calling the bluff again. They're saying, we don't trust your paper, we want hard assets. And unlike 1971, the U.S. can't just close a window. We can't force countries to hold dollars. We can only make dollars attractive. And with inflation, deficits, and political instability, dollars are becoming less attractive by the day. Now let's talk about the supply side, because this is where things get really interesting. Gold production has essentially plateaued. We're not finding major new deposits. The easy gold has been mined. What's left is deeper, lower grade, more expensive to extract. Meanwhile, demand is surging. You've got central banks buying over 1,000 tons per year. You've got retail investors in Asia buying gold like never before. You've got institutional investors adding gold as a portfolio hedge. And you've got industrial demand from electronics and technology. All of this is competing for a relatively fixed supply. Basic economics tells you what happens next. Price has to rise to balance supply and demand. But here's the twist. Unlike most commodities, higher gold prices don't significantly increase supply. You can't just turn on more gold production. It takes years to develop a mine. So the supply response is slow, while demand can shift quickly. This creates the potential for explosive price moves. We saw a preview of this when gold went from $1,800 to over $4,000 in a relatively short period. That's not normal commodity behavior. That's monetary behavior. That's people fleeing into safety. And here's something most people don't realize. Gold isn't just competing with other investments. It's competing with cash. When you hold cash, you're losing purchasing power to inflation. When you hold gold, you're preserving purchasing power. As more people understand this, the shift from cash to gold accelerates. Think about the average person's financial situation. They've got money in a savings account earning maybe 4% interest. But real inflation, not the official numbers, but what they actually experience at the grocery store, at the gas pump, in their rent, is running much higher. They're losing ground. They're getting poorer in real terms even though their account balance is growing. Gold offers an alternative. It's not about getting rich quick. It's about not getting poor slowly. It's about maintaining your purchasing power over time. And as this message spreads, as more people wake up to the reality of currency debasement, demand for gold will continue to grow. Now, I want to address the skeptics, because there are always people who say, gold doesn't pay dividends. It doesn't generate cash flow. It just sits there. And they're right. Gold doesn't produce anything. But that's not the point. Gold is insurance. It's a store of value. It's a hedge against the system failing. You don't buy fire insurance hoping your house burns down. You buy it in case it does. Gold is financial fire insurance. And right now, there are a lot of fires starting in the global financial system. Look at the banking crisis we saw recently. Multiple banks failed, depositors panicked, the government had to step in with emergency measures. And what happened to gold during that crisis? It surged. Because when people lose faith in banks, they turn to assets that can't fail, that don't have counterparty risk. Gold has no counterparty risk. It's not someone else's liability. When you hold physical gold, you own it outright. It can't be hacked. It can't be frozen. It can't be inflated away. In a world of increasing financial complexity and risk, that simplicity is valuable. Let me share a story that illustrates this perfectly. In 2013, Cyprus had a banking crisis. The government, with EU approval, confiscated a portion of bank deposits over a certain threshold. People woke up one morning and found their account balances had been reduced. Their money, which they thought was safe, was taken to bail out the banks. Now, if you had gold during that crisis, it was untouchable. The government couldn't confiscate it without physically coming to your house. Your wealth was protected. That's the power of holding hard assets. We're seeing similar dynamics play out globally. Negative interest rates in Europe and Japan, capital controls in China, currency devaluations in Turkey and Argentina. Everywhere you look, there are examples of governments and central banks taking actions that hurt savers and benefit debtors. Gold is the escape valve. It's how you opt out of that system. And as more people realize this, the pressure on gold prices will intensify. Here's another angle to consider: generational wealth transfer. Baby boomers hold an enormous amount of wealth. As they age, they're becoming more conservative, more focused on preservation rather than growth. Many are shifting from stocks to safer assets, and gold is increasingly part of that conversation. At the same time, younger generations are deeply skeptical of traditional financial institutions. They've seen the 2008 crisis, the COVID money printing, the inflation that followed. They don't trust the system. And while some are turning to cryptocurrencies, others are discovering gold. Not their grandfather's gold coins, but modern gold-backed products, fractional ownership, digital gold platforms. This creates demand from both ends of the age spectrum: older investors seeking safety, younger investors seeking alternatives. Both groups are discovering gold, just through different channels. Now, let's talk about the technical picture, because the charts are telling a compelling story. Gold recently broke through major resistance levels that had held for years. When you see breakouts like this, especially on high volume, it often signals the beginning of a new trend, not the end. Technical analysts are pointing to measured move targets well above current levels. They're looking at cup and handle patterns, ascending triangles, all sorts of bullish formations. And while I'm not a pure technical trader, I do think the charts reflect underlying fundamentals. They're showing that buyers are overwhelming sellers, that momentum is building. But here's what really matters: the fundamental drivers behind this move are strengthening, not weakening. Central bank buying isn't slowing down. Geopolitical tensions aren't easing. Fiscal deficits aren't shrinking. All the factors that drove gold higher are still in place, and in many cases they're intensifying. This is why I think we're in the early stages of a major bull market. Not a short-term spike, but a sustained move higher that could last years. The kind of move that creates generational wealth for those positioned correctly. And positioning correctly doesn't mean going all in on gold. It means having appropriate exposure based on your situation. For some people, that might be 5 to 10% of their portfolio. For others, especially those concerned about systemic risk, it might be more. There's no one-size-fits-all answer. But what I can tell you is this: having zero exposure to gold in the current environment is a bet. It's a bet that central banks are wrong. It's a bet that the dollar will remain strong despite massive money printing. It's a bet that the current financial system is stable and sustainable. And based on everything I'm seeing, that's a bet I wouldn't want to make. Let me give you one more piece of the puzzle: the gold to silver ratio. Historically, this ratio has averaged around 15:1 to 31. Right now, it's much higher, which suggests silver is undervalued relative to gold. If gold continues to rise and silver catches up, which it typically does in bull markets, we could see explosive moves in silver as well. This matters because silver is more accessible for average investors. You can buy meaningful amounts of silver with modest capital. And if the ratio reverts to historical norms, silver could outperform gold on a percentage basis. But whether you're looking at gold, silver, or other precious metals, the underlying thesis is the same. We're in a period of monetary instability, and hard assets are the place to be. Now, I want to be clear about something. I'm not saying the dollar is going to zero tomorrow. I'm not predicting an imminent collapse of the financial system. What I am saying is that the risks are elevated, the trends are clear, and the smart money is positioning accordingly. Central banks are buying gold at record levels. Institutional investors are increasing allocations. Retail demand is surging in key markets. These aren't random events, they're signals. And if you know how to read them, they're telling you something important about where we're headed. The Great Reset, whether you call it that or something else, is about a fundamental repricing of assets relative to currencies. It's about the recognition that unlimited money printing has consequences. It's about the shift from a unipolar dollar-dominated system to a multipolar world where gold plays a central role. And here's the thing: you don't have to believe in any particular narrative or theory. You just have to look at what's actually happening. The data is clear. The trends are undeniable. Gold is being remonetized in real time. This creates an opportunity. Not a get-rich-quick scheme, but a genuine opportunity to protect and grow wealth during a period of significant change. The people who recognize this early, who position themselves before the crowd, will benefit enormously. Think about those who bought gold in the early 2000s, when it was $300 per ounce. They watched it rise to $1,900 by 2011. That's more than a 6x return. And we could be at a similar inflection point now. Not because history repeats exactly, but because the underlying dynamics are similar. Excessive money printing, geopolitical instability, loss of confidence in fiat currencies. The difference this time is the scale. The money printing has been larger. The debt levels are higher. The geopolitical tensions are more severe, which suggests the move in gold could be even more dramatic than previous cycles. I know this is a lot to process. It's a complex story with many moving parts. But the core message is simple. Gold is being reset higher, driven by forces much larger than any individual or institution. And those who understand this, who position themselves accordingly, will be on the right side of one of the most significant financial shifts of our lifetime. So what do you do with this information? First, educate yourself. Don't take my word for it. Look at the data. Follow central bank purchases. Watch the price action. Read what credible analysts are saying. Form your own conclusions. Second, consider your exposure. If you have significant assets and zero gold exposure, ask yourself why. Is it because you've made a conscious decision based on analysis, or is it because you've never really thought about it? There's a difference between informed choice and default positioning. Third, think long-term. Gold isn't a day trading vehicle. It's a strategic holding. It's something you accumulate and hold through cycles. The people who do well with gold are the ones who buy and hold, not the ones who try to time every move. And finally, understand that this isn't just about making money. It's about preserving what you've already earned. It's about protecting your family's financial future. It's about having a hedge against uncertainty in an increasingly uncertain world. The Great Reset is happening, not as some orchestrated conspiracy, but as the natural consequence of decades of monetary policy decisions. Gold is at the center of this reset, and the repricing has only just begun. The question isn't whether gold will go higher. The question is whether you'll be positioned to benefit when it does, because this train is leaving the station, and once it picks up speed, it's going to be very difficult to catch.